Thank you very much for joining us. My name is Norman Villamin. I am the Chief Investment Officer for Wealth Management here at UBP. I'll be joined as well by Peter Kinsella, who's UBP's Global Head of FX Strategy, to share with you our views on the markets and how we see this uncertain period playing out in the months ahead. For those of you who have participated on our webinars before, you'll know that you can submit questions anytime during our conversation via the Q&A box in your app. And in addition, we'll be taking all the questions at the end of the session. So why don't we kick off in terms of the markets? And so if we move to the next slide in the pack, one of the things we wanted to do is really focus on a lot of the questions, one that we have been getting from a number of our clients around the world, and then as well, the questions that we think are going to be very relevant as we're making decisions about opportunities as well as risks in markets looking ahead. Those questions as we see them are, one, what does a post-lockdown recovery look like in the US, Europe, and China? Secondly, we've seen the Federal Reserve in the United States announce a number of measures, what we like to call whatever it takes, US version. Some of that has been priced into asset classes. Which asset classes are still poised to benefit from those measures? The third question focuses on the equity market. We've obviously seen a very dramatic rally in equities off the March lows. How should investors position in global equities after that rally? Fourth, something that has come on the radar once again is the euro area. We've seen the political rifts, a recent ruling out of a court in Germany. I'll speak about that as well as Peter. And then lastly, over the last few weeks, we've seen a lot of volatility in crude oil. So we'll share our views on crude oil. If we move to the first slide, the issue of recovery, I think very much is similar to the issue of what does the decline in the economies look like. If we look over the last 8-10 weeks or so, we've looked very much to China to map out the infection pace, when it peaks, as it comes off. And in a similar way, we should look to China as they open up their economy, as the different segments of the economy start to recover. And as you can see on this slide, we've led China a little bit here, given their earlier lockdown and opening up phase. And what you see is the sharp slowdown, which all the major economies in the world are in right now, this stabilization phase. And so in the case of China, they're in that right now. For most of the Western world, that should continue through the second quarter. And then what we expect out of China is a restart of stimulus, infrastructure spending, and consumption. And that should allow for a moderate recovery to begin in the back half of this year. So that's the way we see it playing out. The magnitude of stimulus will be important. And so in that sense, the US and the Chinese, we think, will lead that effort going forward. What we've seen in Europe, because of the political constraints, probably means the magnitude of their recovery will be much more muted in the months ahead. How do you benefit from, in particular, the Fed policies that have played out? Again, what we call whatever it takes. We think a lot of people here in Europe actually have that model in the back of their mind. Essentially, the US Central Bank is taking a page out of the ECB playbook from the Eurozone sovereign crisis, trying to ease financial conditions by compressing spreads, first in the government bond market, and then now in the credit markets. We think we're at the early stages of that. You can see this pattern that we've laid out in the context of Europe. The US, as they begin buying bonds, you should see spreads start to come in here. But one of the key differences between the US and Europe, where in Europe it was okay if you like to buy investment grade and high yield ETFs to participate in this. One of the things we think is you want to be an active investor in credit here because of the risk of downgrade, because of the risk of default in the current environment. If we move to slide 5, the other asset class that's going to benefit, we think, very much in the medium term is going to be gold. Gold right now is pricing, again, very much a financial crisis style outcome. We don't think that necessarily plays out. There is that risk, which we can talk about. But if you look at this right-hand slide, if you look at USM2, and this chart goes back to the 1960s, even with the rally that we've seen here, we think gold is undervalued at this point. And as we look into year end, the Fed will expand its balance sheet to about $10 trillion. We think that will bring a tailwind to gold prices moving into 2021. Peter will get into this in a bit more detail. Moving to the next slide on equities. Again, one of the things that we encounter as we talk to our different clients is a number of them have different perspectives on what the outcome is looking out 6 to 9 months. Some are very, very negative. They think this is a repeat of 1929. Some are very optimistic. They think it's going to be V-shaped and we should recover very easily in 2021. This is the framework we try to use to help us understand what the market is telling us about the outcome. And so where we sit today, a lot of people say valuations looks very rich. They do. But what we focus on is valuations on what we call longer term trend earnings. And if we look at that, if we assume that we can get back to kind of a 2018, 2019 style type of return by corporates, that type of earnings environment, we think there's modest upside at this point. Or if you want to be very optimistic at the very peak of the cycle, you could see as much as 18% upside from here. However, our more modest assumption of a slow and grinding recovery through the end of the year, and then historically it's taken about 2 years to return to these types of returns on the part of corporate earnings, that suggests we're probably about 7 to 10% overvalued here. Because the Fed in particular and other central banks have moved very aggressively, we think this depression outcome has been taken off the table for now, but we just wanted to give you a sense of what that risk would look like if it were on the table. And again, that's another 20 to 40% downside from here. Go on to the next slide. Again, pivoting to the euro area, and Peter's going to get into this in a little bit more detail. All of the news we've seen over the last few weeks in Europe suggests to us that an increased risk premium and so a higher rate of return you're going to have to ask for Europe to adjust for these risks. And so when we look at our equity allocation in particular, that leaves us a bit more cautious about both the prospects of recovery and what we're willing to pay for that recovery in Europe. On the next slide. Just to wrap up on crude oil, we continue to see a lot of volatility in the last few days now to the upside from here. I think it's very interesting to put the news into context. Obviously, OPEC has cut supply by about $10 million a day. You're seeing other countries shut down capacity. And so net, that should bring us close to somewhat balance in the economy, in the oil markets as economies move out of lockdown. But what we want to focus on is the catalyst for a sustained rally in oil, we think is this inventory story. You can see inventories are now near 12-year highs. If we look back to the last trough in oil in 15 and 16, that trough really didn't start to translate into upside movement in oil until inventory started coming in. So that's what we're focusing on here. Either you want to stretch time horizon and watch inventories come in, or you want to be very tactical in the oil space and protect downside in the event of renewed volatility. On the next slide, just a summary point in terms of a number of things we've talked about, and we can get into this in the Q&A. But I'm going to pause there. I'm going to hand it over to Peter to talk a bit more about FX, gold, and the euro.
Okay, thank you, Norman, and good morning to everybody. I'll get started today. I'll talk briefly about what's happened with the dollar, what's happened with the euro, sterling, and then, of course, look at what's happening with the gold market. As you can see from the slide that we're currently looking at, we've seen this year that most of the major losses in the currency space have been in sort of so-called high beta currencies, which is to say these are currencies which are very cyclically exposed to the global economy, your traditional kind of small open economies. And indeed, what you've seen is that the likes of the Norwegian krona, the New Zealand dollar, Canadian dollar, and sterling, even the Australian dollar, have all sort of exhibited or illustrated modest losses against the dollar. However, the chart on the right-hand side basically shows you that the distribution of these losses has not been linear in any sense. What we've seen is that certainly in March, the dollar appreciated very significantly, and indeed the so-called high beta currencies made very large losses. Since March, and indeed since the actions undertaken by the Fed, the European Central Bank, and a whole variety of other central banks, we've seen these currencies basically start to gain some ground against the dollar. So really what we're seeing is a very nascent recovery in the FX space, consistent with the modest recovery we've seen in economies, or at least the improvement in broader risk sentiment. Bringing you to the next page on slide 3, what we can see in terms of looking at the dollar are a number of factors. Firstly, coming into the crisis, the dollar traded at very expensive levels. This is true in real effective exchange rate terms and indeed in trade weighted terms. US President Donald Trump has often repeated his alarm at how expensive the dollar has become. If we look at the chart on the right-hand side, we've seen that the dollar has really lost a permanent interest rate advantage. So US 10-year yields have now broken significantly below 1% and are kind of hovering in and around 60 basis points, and the front end two-year yields trading in and around 25 to 30 basis points. Bear in mind, last year we were looking at a US 10-year yield, roughly of around 2%, even or thereabouts. So the broad point is that the dollar has definitely lost a permanent interest rate advantage, and this will weigh on the dollar as the recovery manifests itself in the coming months and quarters. Bring you to the following page. What we can see is that going to the euro is that we can see that the old sort of fundamental drivers will have a large impact on euro dollar. And what Eurozone, for all of its political problems and indeed the various stresses pertained by EMU, it does illustrate an enormous current account surplus, whilst the US illustrates a very wide current account deficit. The euro is very, very undervalued. It trades at very low levels in traditional real effective exchange. Euro dollar and trade weighted euro would indicate that fair value for the euro is somewhere around 125 to 130 against the dollar. In the context of much lower hedging costs for the US dollar, and indeed a nascent recovery, which we're starting to see, finally, in addition to a situation where the Fed is actively easing policy, this will eventually lead to a weaker dollar over the medium term. In terms of the EMU stresses and strains, whilst the decision yesterday in the German Constitutional Court has thrown a modest sort of spanner in the works, we think the ECB will be more than able to argue that its purchases of government bonds have been proportionate. And indeed, we think that the European Court of Justice, its ruling is unlikely to be overturned at this point. So really, we don't view that the Constitutional Court decision as being material at this point. That said, we do anticipate that the large increase in Italy's debt GDP ratio, probably in excess of 150 to 160%, and the large decline in Italy's primary surplus will indicate that investors will start to demand higher risk premia for Italian debt. So the widening that we've seen in Bund BTB spreads, we think is going to be here to stay, but that shouldn't at this point lead to a dramatic increase in or decrease in the euro, mainly because the ECB is mopping up any large spread movements with increasing asset purchases. And indeed, we would anticipate that the ECB may increase its asset purchases modestly over the remainder of the year. So all told, we do anticipate a very modest up move in euro dollar, mainly a reflection of dollar weakness. Bring you to the following slide, talking about sterling. For sterling, we think there are a number of risks at present. We see that sterling is cheap, and indeed sterling has been cheap for a considerable period of time. That said, we've seen the UK economy have a very drastic deterioration consistent with the COVID-19 related shutdowns. We know that tomorrow the Bank of England will hold its monthly meeting, and it is quite likely that the Bank of England will announce very significant downgrades to their economic and inflation forecasts. There is the possibility of further Bank of England easing on the next slide, which will basically, and indeed the Bank of England has already committed to purchasing around £200 billion worth of assets. We think there is a possibility that the BOE may do more. And certainly looking at the options market, we do see that on the chart on the left-hand side, which shows you the risk reversal curve, And it is apparent that markets are quite bearish on sterling. Additionally, we then have political risks. The ongoing Brexit talks have not yet yielded significant progress. So there are some short-term downside risks in sterling. That said, we think that if we see sterling trade to levels of around 120 against the dollar, this is definitely a buying level, or a level to buy sterling at. Over the medium term, we do anticipate that fair value for sterling against the dollar is at levels of around sort of 135 to 140. Bringing you to the following slide, where we'll just talk briefly about the Swiss franc. We've seen that indeed the franc has steadily appreciated over the last number of years. We can see that both dollar Swiss and euro Swiss have continued to decline. Recently, we've seen a very, very significant increase in the SNB's so-called sight deposits, which is an indication of SNB interventions designed to slow the pace of franc appreciation. The bottom line for us really is that we see continued appreciation pressure on the Swiss franc, reflecting Switzerland's very large current account surplus, significant significant capital inflows. The bottom line for us is that we think Euro Swiss can fall to levels of around 1.02 by year end, and dollar Swiss may trade lower towards levels of around 0.93 by the end of the year. Bring you to the following slide, talking about Japanese yen. Again, we think here that we will see modest dollar yen declines, largely reflecting the large decrease that we have seen in US Japanese real yield differentials, which is the chart on the left-hand side. The development of US Japanese real yield differentials is consistent with levels in dollar yen of around 100 or even slightly less. Additionally, we do believe that the yen is trading at very, very low levels in both trade-weighted and real effective exchange rate terms. So the bottom line for us is that we anticipate a continued modest down move in dollar yen and very broad but slow appreciation of the Japanese yen. And finally, we'll bring you to gold, which I think is coming up to the last slide on the presentation. And the next one. Our view on gold really is quite constructive. As Norman mentioned, basically we see a number of drivers for continued increases in gold prices. First, we've seen the development of USM2, or broad money growth, which is indicative of levels of around $2,100 to $2,500 per ounce as being kind of a fair value for gold. So certainly gold at the moment continues to be very undervalued. We anticipate that US real yields will continue to post a highly negative profile over the coming years, and this indeed means that the cost of holding gold in real terms has declined. So in a sense, the relative cost of holding gold has declined because gold is of course a non-yielding asset. Gold positioning at the beginning of the year was very long. It was a very, very consensual trade. But the large down moves we saw in markets during March led to a big shakeout of positioning, and consequently we saw gold trade that little bit higher. Additionally, we have seen that central bank purchases of gold have moved to multi-decade lows, and consequently we do anticipate that over the coming year or two, central banks will diversify and allocate increasing quantities of their reserve assets towards gold. So the bottom line really for us is that in an environment of negative real interest rates, not just in America, but indeed around the world, holding gold makes eminent sense. And indeed, the positioning shakeout does tend to lead us to believe that we will see a little bit more upside over the remainder of the year. Our year-end forecast for gold is at levels of around $1,900 per ounce, and indeed we do think there are upside risks to those forecasts. And with that, I'll pass you over to Norman, who will manage the Q&A.
So with that, I see there are a few more questions on the line. We will try and address those to you via email. If you have any other questions in the future, feel free to submit them by email. The email address is investments@ubp.ch. We will be doing these calls on a regular basis, especially in this uncertain environment. So this is a great opportunity for us to exchange ideas about what we're thinking and where your concerns are. So I thank you for taking the time. You'll see on your screen, if you want to receive our feedback and our updates on a regular basis, please feel free to sign up on the UBP website. The details you'll see on your screen. Thank you very much for joining.